Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. Apologies for not posting a video in the last couple of days. I haven't been well enough, but alhamdulillah now I feel like I'm better. Today is actually the first time I actually feel like I can speak and I can hear my own voice without the madness, but alhamdulillah things are getting better. But today's video I want to focus on one stock that we've never actually spoken about in this channel, and this is a growth oriented business, okay? And normally growth oriented businesses kind of make a great investment because they are always basically reinvesting back into their business. And one of the things I like about them is the fact that they only focus on areas of the economy that are still growing. So they focus on areas that are still growing and then reinvesting that, basically their returns into the business instead of giving us as a dividend and so on. And in the long run, these are the type of businesses that will give you an excellent, basically, investment return for investments. So that is what I want to share with you guys. I want to share with you a company today. But before I do that, there's a couple of things I want to say. The first one I want to talk about is, as you can see, the portfolios are now crossed over £70,000, which is absolutely amazing. Alhamdulillah. But the other thing I want to say as well is it might not stay that way this week because there's a lot of companies reporting the earnings, and the earnings season actually started already. I think it was started on last week, Thursday and Friday, where a lot of the banks have actually reported. And again, the banks were actually on focus because of what's happened recently to the regional banks and so on. So it will be interesting to see what this week brings. But there's so many companies, including the ones that I own. For example, like J&J is actually reporting on Tuesday before the markets open. You've got companies like United Health and so on that are reporting. You've got ASML reporting on Wednesday before the markets are open. It will be interesting to see that one. You've got Apple there. You've got Tesla reporting, Lam Research. You've got TSMC also reporting, American Express, as well as Union Pacific, which is a company that I own in my portfolio. PPG is reporting, and Procter & Gamble is reporting on Friday. SABP is basically reporting as well on Friday. So you've got loads of different companies reporting, and this is it. So it started like beginning end of last week, and it's going to continue for the next 4 weeks. So expect some sort of a volatile market, I'll be honest with you, because if some of these companies come out and obviously they say things like, for example, they're seeing consumer not buying as much as they used to and whatever, then that means we're probably heading towards a recession. People are a bit more cautious with their money. People do not want to spend and so on. And that's just the start of the doom and gloom, because if you think about it, if consumers are not basically spending, then these companies are not going to make any money. Consumers are worried about where their next paycheck is going to come from. Then obviously they're going to start worrying about this whole thing. Although unemployment is actually quite low, that could potentially trigger something. So it will be interesting to see. It might actually be completely the opposite, and everything is amazing, and the bull market starts from there onwards. So inshallah, whatever happens anyway, remember, the most important thing for us as basically long-term investors is to look for opportunities. So if things go down, as companies like Union Pacific comes down again, maybe another 4 or 5%, I'm happy to add to it, because I know this is one of the companies that I want to own for at least 5 to 10 years, if not longer than that. So inshallah, we'll see where we are by the end of the next 4 weeks. We will see inshallah where we are. The company I want to talk about today is Dexcom. This is one of the companies that are in the healthcare sector. This is one of the companies that works, basically they produce products that are in the diabetes, if you like. And as you know, diabetes is a growing concern for the healthcare industry. And right now in the US, there's almost about 29 million people that have been diagnosed with diabetes in the US. And there's probably another 8.5 million people that are estimated basically are still undiagnosed, that have not been diagnosed yet. So as you can see, just in the US, you're looking about almost 40 million people just in the US, and around the world, I'm sure there's a lot more. So this company has the product basically that is needed to help these people. So this company actually makes the monitoring systems or devices that basically people use in order to monitor their basically diabetes. So as one of the companies that we've actually never spoken about, so it seems it is in the right industry. although it's very sad that we're talking about diabetes and basically money making out of that situation, which is absolutely horrible. But the company actually produces the monitoring system, the glucose monitoring systems that actually devices that help these people, which is actually, in fact, it is a good thing. The fact that they actually coming out with these devices that are helping others to actually control their diabetes. So I'm going to dive into now the financials of the company. But if you want to know more about how the industry, where the industry is and where it's heading, then obviously you're just going to have to do a little bit more research on that. But yeah, so just let's start with the financials of the company. So like I've already said, the Texan company, they have basically $115 per share right now. And year to date is actually just up about 2%. 5 year, you would have actually made 530% total return on price appreciation if you actually own this company in the last 5 years. EPS is very low. Obviously, it's still basically a growth company, so 0.80. Market cap of $45 billion market cap, so it's actually quite good. In terms of economic mode, I was surprised to see it says none, but I think it's probably one of those their products are probably easily replicated, I guess. Beta is actually quite high in comparison to the rest of the in comparison to what we're normally looking for, which is 1. Okay, PE is very, very high, 114, let's call it 145. Forward PE 110. 5-year average, when you look at the 5-year average, this is not bad at all, 146 PE. Okay, in comparison to the sector, which is like right now is about 27. That is very, very high. But again, when you see the growth of this business, you'll know exactly why investors are betting on this company. Basically, price to free cash flow, we're looking at about 163 as well. Now, in terms of free cash flow, this company obviously does not pay any dividends, but in terms of free cash flow, they have $304 million in the bank right now, and they've got free cash flow margin of 8%, but free cash flow yield is actually 0.70, so it's less than 1%, so that's not a lot at all. But I think with growth companies, you kind of tend to see this, and over the years they start growing their free cash flow. That's when the companies becomes a little bit more profitable. In terms of profitability, profit margins is actually decent, operating margins, return on equity, total return in the last 10 years, actually you would have made about 40%. Basically, return on invested capital is about 8%, and revenue growth in the compounded annual growth of 33%, let's call it 34%, which is absolutely huge. And current ratio is above 1, so they've got enough money to cover their current liabilities if they need to. This is why the investors are basically betting on this company to do really well, because if you think about it, next year they're expecting the earnings to grow about 40%. That's absolutely huge. And then growth estimated for the next 5 years per annum, every single year for the next 5 years, they're expecting at least a 30% growth. Again, remember, this is based on what the analysts think. This is not just accurate information. This is based on their estimation. So you have to basically be careful with that information, right? But 30-40%, that's absolutely huge. And that's why this company is actually trading high multiples, and investors are willing to pay for that because of this growth. Remember, this type of business is high reward, high risk kind of thing. Okay, so the risk is high, but the reward is higher if you're actually willing to actually be patient and actually hold on to this type of business. If you know the business model and you believe in it, and you probably work in that industry, okay, you have a little bit more ideas of where things are going in terms of diabetes products and devices and so on, then you could potentially buy this company and hold on for at least for 10 years and then see where it goes, because you probably know a lot more than I do, right? Current ratio and price, we're looking at about $115 per share. And according to Simply Wall Street, it's actually saying it's overvalued 67%. It's almost to 68%. So it's their price target is just about below 70 pounds, $70. According to Morningstar, is also saying it's overvalued, but Morningstar is actually saying about $92 per share is basically where they think the price should be. Target price for the next 12 months from TipRank is actually 132, so it's basically upside about 13%, and same goes for Seeking Alpha. So these two kind of agree on the next 12 months the price should be higher than where it is right now, which is actually interesting. it should be if you're looking at this type of growth. But at the same time, they actually saying it's a buy. So yeah, so you've got mixture there. Okay, these two are using intrinsic values and saying right now the company is overvalued, whereas these two are saying the price target for the stock basically for the next 12 months is way higher, basically about 12-13% of higher than where it is right now. They consider it a buy. In terms of the business model, Sharia compliance side of it is 100%. Interest bearing debt basically is about 5%, and 5% just in terms of interest bearing securities. Obviously, you would expect this type of business to dilute the shares as your time goes by. They will start buying it back in the next 5 to 10 years once they become a mature company. But right now, they still actually diluting. They haven't done it basically just this year, so hopefully they'll start buying it back. But again, you expect that because they don't want to go to the bank and get the money, so they actually dilute the shares so they can actually basically reinvest that money into the business if you want. Now, in terms of revenue growth, we're looking at from 2019, it was 1.4 billion to right now $2.9 billion. So it's actually heading the right direction. It's increasing every single year, and the cost of the revenue has obviously gone up with that, and the gross profit from 931 million to right now 1.8 billion, which is actually quite nice. Free cash flow basically gone up from 134 million to right now 300 million, so it almost basically doubled that, so which is quite good. So everything you look at from the revenue growth, from basically cash flow and everything else is actually heading the right directions, and they are expecting this to continue for the next couple of years. This is very, very expensive. Okay, when you look at that, it's very expensive, and obviously is agreed by these two companies, that actually two analysts, that simply Wall Street and Morningstar. So I would definitely say this is one of those companies that if you were to invest in this, don't invest more than 1%. I'm not giving you financial advice, but I'm just saying don't do more than maybe 1% of your overall portfolio. If you have similar sort of companies, you have to be really careful. If you know the industry that well, you know the type of product this company actually has, then maybe you can say about 2% to 5% in overall. But if you don't know much about it, I will probably be a bit more careful. I'm really interested in this business, but I need to learn more about that side and the demand for the product and so on, and how sustainable is that demand. And then obviously I would love to see this PE come down. This is really high. This is in comparison to the sector. I get the sector is full of companies like Pfizer, which has like a single digit PE. But at the same time, this seems for high growth companies. Yes, you expected this, but this is still a difficult one to swallow. But again, when you look at this, you're like, okay, maybe I can just add 1% of my portfolio of this type of business. But yeah, like I said, it's an interesting business. I want to share with you guys. We've never looked at it again. It seems it's very much in the kind of in the right industry right now, where things are basically moving forward in terms of like a glucose monitoring systems devices that this company has. So yeah, I just want to share that with you guys. I hope you're having a wonderful day. I will be doing a couple of more videos in the next couple of days, inshallah. Maybe today after iftar I might do another one, inshallah. Right now I'm fasting, and but yeah, alhamdulillah, things are good. Alhamdulillah, I feel better to actually be able to record this for you guys. So make dua for me, make dua for my family and all of us, inshallah. My life accept our du'as and prayers and our fast and everything else, inshallah. Have a wonderful day. Take care. Assalamu alaikum.